When we talked about the pension transfer, the transfer is transferring the responsibility to insurance companies who now bear the responsibility, because obviously nothing bad can happen to insurance companies. And we started talking about this then, that it's not just the banks that are strained and loaded with assets that have, I guess you could say, become toxic. Assets that were always considered safe and reliable are no longer such, as interest rates are rising again. And the insurance companies and the banks had bet that that wouldn't happen again, but yet it is happening again. The insurance companies are loaded with treasuries. That's how they in their mind, are able to guarantee a good portion of their obligations. It's not the only thing they're invested in, but a large portion of what they are invested in would be treasuries, would be things that could certainly have a similar effect in terms of problems in a rising interest rate environment that the banks have. And when we talk about what's happening in California, my heart goes out to all the folks there, and it's hit close to home because one of our own, Megan, my assistant, their family lost their home, completely, totally gone in Palisades. And listening to someone who's actually going through it is heart-wrenching. But this is no small deal. This is, when you talk inflation-adjusted dollars, this is 60% more than the most expensive wildfire in history, at least as of right now. The insurance companies are on the hook for well over $20 billion in damages. And this is exactly the kind of event, the unforeseen event, that can very quickly change the narrative as it pertains to the health of these insurance companies and the health of the reinsurance companies who are backing them up. We're already seeing massive strain on the stock values and the book values of these insurance companies just overnight. Many of the insurance companies saw this coming and bailed. State Farm, I think it was 1,600 policies they did not renew as of July in California because they saw this coming. This is a massive strain that could very, very quickly become something much bigger, as the amount of money that they're going to have to come up with is extraordinary. And this could change not only their books, but the reinsurance books and the banks that they all do business with. This is the kind of event that strains the system. And then they have something, I forgot the name of it. Let me see what the name of it. I think it's called Real. What is the name of it? Give me a second. There is a program that they have in California, especially in this area, that is backed by the government. And I don't know the exact name of it. The point of it is, what I'm really trying to get across is, and something like California Real or something along those lines, the commissioner of this program a year ago went in front of the legislature and said that this community pooled insurance program for those folks in high-risk areas like Palisades who couldn't get insurance because of fire risk is woefully under capitalized and has great exposure to risk. This is exactly what she's talking about. So not only are the private insurance companies in big trouble, now you have the government-sponsored programs that are in trouble in a state that is massively underwater. Where does the money come from? And this is a growing problem. God forbid there's another problem that pops up out of nowhere, and then things start to become exponentially more difficult. You have any thoughts on it, Mario?
Well, I mean, I haven't looked that carefully into the insurance situation, but one thing I would say that is more of a bigger picture view is that a lot of people in the financial sector, economists, mainstream economists, they seem to think that the bond market is going to continue to perform like it had since 1981. They don't see the rising yields that we've seen in the last 2 years as a change a change into a bear market. And I think that's the whole problem for insurance companies, pension funds. They've been used to been able to always refinance at lower rates, and they've had to leverage as well because rates were near zero for so long. So I think it's a big problem. And we were talking last night, Andy and I, about the 1907 earthquake in San Francisco, how that triggered a big financial disaster back in 1907 that eventually led to the creation of the Federal Reserve. So these fires in LA, they could be the trigger. Right now, it's still too early to say, but I think we should keep an eye on.
And the people who are thinking rates will never go higher, this is the biggest ever move higher in yields following the first Fed cut ever. And so it's moving counterintuitively to history. It's moving counterintuitively to the Fed's wishes by lowering the front end of the curve. The back end is going up. We were also talking, Mario and I, about what's happening in the UK regarding yields, and he was saying the bond yields on the 10-year, 30-year, what, 5.6, 5.7?
Yeah, almost, and it's at the highest level since 1998.
Right, and so this is not just the United States. This is happening to our allies across the pond. Higher rates is a consequence of all the money creation, of monetary and fiscal irresponsibility, and there's no way around that, which will just add strain to the already over-leveraged, undercapitalized insurance industry and banking industry. And this is something that I think will become a major focus of anyone running a business or trying to figure out the cost of money. It has to move higher on the back end of the curve, and that is the part of the market that all of the loans and the leases and the mortgages and the credit cards, all of the important things are based off of, not the federal funds rate.
I wanted to read a couple paragraphs at the very end of John Rubino's article because he brings it home to what's the consequence on the financial system versus what are our typical political attempts to solve things like this. He says, this raises a point few seem to ponder. The world isn't simply a political structure, yet virtually all the proposed solutions to every problem are political or technological in nature. We can solve this or that politically or with AI. That the private sector can trigger crises that have no political or technological fix is on very few pundits' radar. The problems being exposed do not lend themselves to tidy political or policy fixes that magically return the world to the past era of lower risks. Risks and losses cannot be extinguished. They can only be transferred to others. This is the intrinsic limit of political fixes. We take the risks and losses and transfer them to others lacking the political power to contest the transfer. Or we transfer the risks and losses to the entire system, increasing the potential for a systemic collapse. And that's where I'm very concerned on behalf of all of our viewers and subscribers and their loved ones and neighbors and coworkers and friends, is this idea of that what it seems that the talking heads on the mainstream financial channels don't see coming, although you can't trust it just because they don't say it, they don't see it, is this idea of the potential for a black swan event or a stone being pulled out from the bottom of the dam and the whole house of cards, sorry, 3 metaphors there, all coming down. And just, I wanted to see if Mario, if we could tap your thoughts on that as far as the risks, what makes this environment that we're now in so different from the environment that prevailed for the past 4 decades that most retail financial planners grew up in, and that they learned their tricks. You know, you guys said you just got back from a round of golf. I heard an old saying. He said, somebody said, I played golf for 20 years. I say, really? Have you played golf for 20 years, or have you played the same year of golf 20 times? In other words, if people are just using the same tricks, the same go-to strategies, but the game has changed, what additional risks are ordinary people being faced with that we have no idea, that they're not being warned about from their mainstream sources?
Yeah, and also the people who have the fiduciary duty to run their investments, they seem to be in the dark about interest rates and how important interest rates are, and the rising yields that we've seen. When the Fed cut rates on September 18th, the 10-year yield was at 3.6. We're now, around 4.8, I think, the last time I saw. So like Andy said, that's going to affect everything, cash flows. And the other thing it's going to affect is the government debt. Government is going to have to issue even more debt to cover all the expenses. That's going to affect the value of the currency. And it's just a huge problem. And the other thing as well, Donegan, is that for 40 years, the bond bull market and declining yields, we always had lower highs and lower lows. That's reversed. And we got so much debt that was created because of that. And now with the rising yields, the risks increase because rising yields and a lot of debt is a recipe for a lot of crises and disasters.
It's also the recipe for a reset.
Yeah.
Reset the system because it's so indebted, and as rates rise, the ability to maintain that debt becomes much, much, much harder. And that's the point. Since 1982, rates have fallen at a 45-degree angle. Everyone thinks that that's just part of the way things go. Falling rates make asset prices higher, and it's moving in the other direction. And the issue is that it's so many businesses and people in general who are trying to calculate their risk and their ability to maintain and service their debt, expect interest rates to continue to fall, but they're going in the other direction. And that would be the catalyst really to blow up the system. And you put that in context with the way the cycle, the psyche of the investor. Last week, Tuesday, was the record. Tuesday was the record trading day in the United States, all-time record for stocks trading under $1. Those are penny stocks. That is associated with speculative mania. And when you put that together with the Trump euphoria, with everyone thinks that everything is just going to get better, and in some degrees, in some respects, it will. But to ignore the financial implications of where we are, how we got here and how we get out of here, and what that looks like, writing that off to this exuberance is going to be, in my mind, a massive mistake. And this is the kind of thing that can very quickly change the narrative. And not to mention, I don't know how many people think that if he really is President Trump fighting the deep state, are they just going to lie down and let this go? Or do they attempt to make things very challenging for him within an economy that is so fragile, it just takes but a flick maybe to cascade things down the hill. And I don't want to go into this realm of conspiracy, but for people to think that this will just be smooth sailing, I think is foolhardy.